Tuur, welcome back to the show.
Hey, Stefan, how's it going?
Going well. It's been a wild week or two in Bitcoin land, and there's just so much going on. So I wanted to chat with you as well. You've been tweeting some stuff out and sharing some insights as well. But let's first get your view on where things are. Actually, this might be an interesting question. Would you say in the last few weeks is when we realized we are actually in a bear market?
Yeah, I mean, honestly, I was surprised, and I think many other people were too. And I think I might have been a bit blind to the amount of leverage that built up in the system. It's just like I don't know, like I don't like counterparties that do risky stuff and that are hard to figure out. And I mean, I think it's just also in general, you stick with what you know, and if you've been in the space for a while, like there are certain companies you know and trust. And so there's like, even today I was just like reading about I forget the name now, Voyager. It's
Voyager,
like
yeah.
apparently some large exchange like I'd never heard of. So it turns out these guys have been doing fractional reserve banking and are probably getting in trouble now. So yeah, I mean, it was a surprise to me. Like I knew things were bad, but man, things were worse than I thought. And like after I kind of recovered from like a slight heart attack, like, what's going on here? I feel really good about this. Like this is like creative destruction at work, and I think it's a kind of a it's going to be painful for a lot of people, but I think it's a needed cleansing before we can actually go off the races. And the beautiful thing about the Bitcoin ecosystem is that we can actually delever. Like there are no too big to fails. Like just we had Mt. Gox, which at the time custodied or was supposedly custodying 7% of all Bitcoin in circulation. So Bitcoin survived just fine. So there is no magnitude of like a Wall Street type crisis that Bitcoin could not survive. And so in doing that now, I think we're setting ourselves up for this decoupling, that Bitcoin is going to decouple from traditional markets and just skyrocket out of this dust cloud, because other markets are in trouble too. Like if you're in Bitcoin, it's like easy to think like, oh, it's just us, but like there's a lot of trouble on the horizon for traditional markets. So that's my thesis. This is a panic, um, and this is healthy, and this is setting us up for some incredible rallies the next few years.
And to your point around correlation and decorrelation or decoupling, as you said, this was a common argument for years and years, is Bitcoin is not correlated with other things. And in recent years, maybe the last 1 or 2 years, that correlation was stronger with traditional markets, say the stock market. So then am I right to read you as saying that decorrelation will come back?
Yeah, and it's every time, it's like every time a lot of people say like, "Oh, Bitcoin is so correlated, this and that." It's like, I mean, okay, well then just express stock markets in Bitcoin and look at what you see, and of course you can see, it does tend to go like there's this sideways triangle pattern that you see. Um, so it does tend to go in a range, trade in a range for a while, but then Bitcoin has that rally that sets your hair on fire, and that's where everybody else is left behind. And that just has happened over and over, and it makes sense because Bitcoin is superior money, and it's being adopted, and we're in a monetary crisis globally, so it just makes a lot of sense that. But the only thing is that traders tend to just look at the short term, and so in a way they create that tension, and then it coils up and eventually it explodes higher.
And with the broader markets, it's probably also fair to say that there's not a lot that people are happy sitting in right now, because even someone who is doing the 60/40 stocks and bonds, they're not really that happy right now. A lot of other assets and other kinds of markets that people are investing into are just not doing that well, wouldn't you say?
Yeah, I saw a graph a few days ago, looking at the performance of the 60/40 portfolio, and it's been worse than I think anytime since 2008, I think it was like minus 15%. So I don't know if your listeners are all familiar with 60/40. The idea is like 60% in stocks and then 40% in bonds. And the idea is that when stocks go down, people are going to hide in safe haven assets like cash and bonds. And so then the bonds are going to go up and compensate for your loss. But so bonds are going down. So that's a weird thing. And like people are starting to have to look into I saw this real estate guy, like a real estate construction specialist, and he was like trying to like look back in historical data, like, oh, what happens when inflation goes up? What happens to housing? And like he had this data set that started in 1990. It's just like, no, you got to look further back. Like inflation, look at the 70s, like look at the 40s. Like you got to like do your homework. You can't just this is not like business as usual. So anyway, people are being like woken up and like the word stagflation, like we gotta like take it off the shelf and dust it off and like what is that? Oh, it's like stagnation plus inflation. So because the past 30 years inflation has always been correlated with growth in the stock market, and the reason is that the Fed and everybody else has been stimulating consumption, and that stimulates stocks. But now people are starting to tighten the belt. They're slowing down their spending, and at the same because of inflation. So that's when you get that stagflation beast on stage, and it's it's everybody needs to update their models.
Right. And as you were saying, with updating models, a lot of people were working in this paradigm where stocks and bonds, one would zig, the other would zag. But it seems what we're seeing now is because bond yields are rising, then bond prices are going the other way. And so that is unfortunate if you are holding bonds. And so that is going to force a lot of people to really stop and think. And so of course, it'll take time for people to recognize what's a better thing. But in your eyes, how do you see people coming around to? Do you see them? Like we don't think they're immediately just going to come around to Bitcoin. It's obviously going to take some time. How do you see that process happening for, let's say, the traditional investors?
Yeah, there's a lot of bargaining happening. Like people being like, "Oh, but what if I just, go to defensive stocks or like, look at the 1970s and, dividend stocks did well then and energy stocks and like Warren Buffett is now I don't know how much he's plowing into oil stocks, but it's a lot. And I don't think those are bad ideas necessarily. Definitely better ideas than real estate or bonds. But like the amount you can just see that the spectrum of potential investments like that is just narrowing. We're starting to get like tunnel vision, in a kind of a necessary tunnel vision because this is a systemic crisis that we're in, and more candidates are falling off the wayside. And so, for example, even like land, like people think like, oh, but land surely must be a good inflation hedge, and the data does. I don't think supports that. Maybe very mild inflation is fine. And of course, at least if you have land, you're going to be left with something and not nothing. So you're better off with some farmland than with some Celsius tokens, or Luna tokens or whatever. Like, yeah, of course, it's something. But is it going to keep up with inflation? I don't think so. I don't think the next 5 or 10 years are gonna help you with that. Is it going to be better than like some real estate development in the middle of nowhere that was hyped up? Like, yeah, of course. Like there's nuance in all this. But yeah, I think Bitcoin is I think what needs to happen and has not happened yet is that Bitcoin needs to be considered to be its own category, separate from all these shitcoins, NFTs, all these protocols that are either centralized or don't have anything new to offer. Um, I think that has been hindering adoption of Bitcoin. And now we have what was $3 trillion in like the whole crypto cap. Now it's back to like 1 trillion, and Bitcoin is winning, right? It's like the meteor fell, and all these dinosaurs are really struggling, and like Bitcoin has been the hardy rat that survives, and then that can grow into a new era. So I think this is what's happening now, and like as Bitcoiners, like not that we have any responsibility, but I think that probably now is an important time to like let our message be heard, because people I think are more listening now. Like it's like, oh, like you can't just buy an index of crypto and say, oh, I'm diversified. Like if there's 9 scams in there, it's not going to help you. Uh, so it's an exciting time. I mean, I feel like there's more signal now than before, and also you can actually talk about scams. Like I feel like some of the Ethereum maxis are a little bit less vocal than they were a couple months ago, and so it just feels safer to come out and say some things.
Do you have
To give an
any?
example.
Sure. And do you have any predictions in terms of what happens with Ethereum, relative to Bitcoin, right? Just, I guess, just for context. So Ethereum's all-time high in Bitcoin terms was something around 0.15 BTC around 2017, and I believe their recent high in this cycle was something around zero point zero 0.08 or so BTC. So I'm curious if you have any thoughts on Ethereum in Bitcoin terms. Do you think that they're going to try to change the narrative to try to pump it again, or are they going to try to say, "Oh, proof of stake is here. Look how good it is"? Or you've seen this narrative as well around so-called ultrasound money. Do you have any thoughts to add on those?
Yeah, let me just pull up a chart here just to jog my own memory. Yeah, it's like I thought. So you're right. I mean, the recent high was 0.087, almost like 0.089 almost in Ethereum. That was like late 2021. That was their kind of like the peak of the NFT craze, I think. And so it's dwindled down, and now we're like flirting with some support at 0.05, and I think 0.05 fits with a long term uptrend. And so they better defend that. And I think the traders probably know it, that that's an important level. I think if they lose it, like, I mean, the next level down is 0.036, but even that is not very strong support. I think it could be game over. Like, I think weirdly, sometimes people hide the truth in plain sight. And so when Vitalik wrote his article, Endgame, I think that'll be the beginning of the end. In looking back, I don't think they have another ace up their sleeve. They've played so many hype narratives over the past 6 years. I don't think the public is going to believe it the next time around. Especially like, what are they doing now? Like second layer Ethereum? Like, just do it on Bitcoin already. Like, if you're going to go second layer, which they've always were against, they were like, no, 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 we're about on-chain scaling. If you're going to build a second layer, you're admitting defeat. So let's just do, and also all this crazy front running of these smart contracts. Like, I mean, how insane is that? Like,
Other
like
MEV stuff.
millions and millions of dollars that you can just see, that is transparent for the whole world to see. Like, so it's just inviting just very bad practices. And it reminds me of, I think we've talked about this before, but like the domain name market, where objectively, if you study those markets, there is much more fraud happening on non.com domain names like .science or .ru or .eu, comparatively to .com. And of course, in that area, it's for sure that it doesn't have anything to do with technology. It's just purely the price mechanism. Like, you have to pay more for a .com name, and so you're going to want to invest more long-term resources and likely have a more honest approach than if you can just rotate and come up with a new name over and over, because these names are super cheap, like pizza.eu or whatever, like insurance.eu. That name is probably way cheaper than insurance.com. So anyway, I just see the same thing in the world of shitcoins, where it's so easy to just rotate, and I mean, Dan Larimer is the king of that. Like, you just launch a new coin whenever you have a new idea, and hope that people forget about your previous ventures. So anyway, I just think that it's showing, that Bitcoin is a more robust platform in many ways. And now slowly smart contracts are gonna also start shining on Bitcoin.
And so earlier we were talking about the leverage that had been built up in the system, and perhaps even people inside this quote unquote industry weren't quite aware of the level of leverage. So maybe you could just expand a little bit on that and perhaps what we've seen over the last month or so with the everything that's blowing up.
Yeah. Um, yeah. Sorry, I'm just kind of like pulling up that thread because I think at some point we might chat about the
Oh
panic
yeah,
of
your thread
19.
on Panic of 1907. Yeah.
But so yeah, the leverage. Yeah, so there were these fund. That's also these hedge funds. So they are like proprietary. Like like a hedge fund basically is when you manage money for friends. Like that's the idea. And so you have less accountability. You need to be less transparent because you only take money from high net worth people because you don't like actively market your fund. That's the original idea of a hedge fund, and so you have all this stuff happening and there's no way to audit what's going on. And by the way, I don't think this model is bad. Like I ran a small hedge fund. Like I don't think this model is bad, but it just kind of explains how it's hard to know what is going on in the market until it unravels. Like it's like what Warren Buffett says, like when the tide recedes, that's when you see who's been swimming naked. Yeah, and so we had these algorithmic stable coins collapsing, which was predictable, and then they were invested in by Three Arrows Capital, and then they started to collapse, and then there were these shops that were offering people yield on their Bitcoin, which we can talk about because I tried to do that with my fund. It's very, very hard to do. And like BlockFi, Celsius, and so they are starting to really get in trouble because they were writing out unsecured loans to these hedge funds that were pretending like, oh, we're gonna make you such and such returns. So it's all kind of there's a lot of contagion, and the buck stops with proper due diligence. Like parties that are conservative, that do proper due diligence, are not, it's not like an actual virus. Like you can actually just have some sound policies and avoid contagion. That probably explains why some platforms are blowing up that you and I have never heard of. It's like what? Um, so so I think one of the parties that is also hurting, that is a little bit less talked about, is the Bitcoin miners. They I don't know how reliable this is, but I sent you.
Oh
Yeah, it
yeah.
was Nick Carter who had this
Yeah,
analysis
so
in
this is
metrics
basically
where.
Bitcoin supply held by a refined, in stars, set of one hop miners. So maybe if you could just explain that metric for people.
Well, to be honest, I don't know exactly what a refined set of one hop miners means. I assume it means that they mine the coins and then the coins are not moved more than one step, like just to their own cold storage. Because otherwise, if they mine it and send it to an exchange, which would be two hops, well then you don't know. Is it going to be sold? Is it held in cold storage? But at least the miners that have their own proper cold storage system set up, then this is kind of like miners that maybe do it right, that have their own cold storage, or at least the ones that we are sure that haven't sold. So there was about 75,000 Bitcoin held in that supply in the late summer, like only 2 months ago. There was like 75,000 Bitcoin held by miners. And that has now declined to about 55,000 Bitcoin. And it seems like we're seeing every day like news of miners selling more Bitcoins. And I agree with Nick that before we can actually say Bitcoin is ready for another rally, we need to see this deleveraging continue. Because what miners do, and I know this because I invested in a mining company back in the day, 2013, 14. Um, what you do is you develop mining machines, or in this case, often you just buy them. You have a bunch of mining machines, you put them in a warehouse, and then you have a contract with both the warehouse and an electricity provider. And so these contracts need to be paid. Like so, it's and either you have a whole bunch of dollars and you use that, or you just immediately sell the Bitcoin that you mine, or if you're really bullish on the market, you pay all that stuff with borrowed money, and you keep all the Bitcoin. And then you're like, oh, this is perfect. As long as the market goes up, it's perfect. But once the market goes down, not only the newly Bitcoins that you mine are worth less, so you might actually be mining at a loss on a day-to-day basis, but also the stash that you saved is worth less and less. And so in order to de-risk, in order to avoid going bankrupt, I believe we will see bankruptcies in the mining space, but in order to avoid that, you just got to sell Bitcoin, and there's just no choice. Like, you just have to do it. So I think miners are definitely, they are like, they boost the price on the way up because they hoard Bitcoins, and then they kind of push the price further down on the way down because they're, like, in this case, they're forced to sell. I think it's just a sign that we're not in a very mature market yet, because what miners should do is they should hedge with derivatives to prevent this kind of scenario from happening. Like, they should have better hedges, but it's a young space, so it's inevitable that something like this happens.
Yeah, so there's lots there. I think one term that's been thrown around is this idea of pro-cyclical, and I guess that's this
Mhm.
idea that miners are pro-cyclical because they're hodling, and in the bull market everything looks good, and they're just borrowing against their coins. And even in recent years, we've seen miners do this whole idea of borrowing against their coins, and that became a lot more prominent in, let's say, this recent
They get
cycle
high
than.
on their own supply.
Yeah, right. And so, and it's not just that they would get loans against not just Bitcoin, but loans against their ASIC miners. And so then, but then the dynamic can become even more difficult because if that uh, quote unquote crypto bank that gives them that loan is now stuck on the other side with these ASIC mining machines that have also come down in price. We've seen a bear market in
Yep.
ASIC mining rigs over the recent few months. So it's kind of all of these factors are kind of coming together uh, at the worst possible time. And of course, there's always been cycles in Bitcoin, and this is part of it. And as you were saying, and I think that I've heard people use this term colloquially, this idea of, oh, this miner is going to puke out their coins, right? Because they were, let's say, too levered or not conservative enough in whatever other way, and I think it's an interesting dynamic as well because it's highly competitive. So you might see a lot of, or let's say, big public miners or even not public miners go and do all this stuff. And then other miners look at other miners and say, hey, well, I'm competing with them to, say, buy ASIC rigs, or I'm competing with them to get rack space or set up a mining area facility. And so you can sort of understand where maybe the competitive aspect, and maybe when everything's in a bull market, everything just looks like it's a good idea. But actually, once the bear market comes,
Right.
that's when things turn.
Yeah, and also the value of these machines. Like, you would think, like, oh, a Bitcoin mining company, like, they have this big space, and it's like, well, the warehouse they probably rent, so that's not theirs. And then the machines, then they have people, but the people are skilled at mining. Like, that doesn't mean that's you can just they can just switch to do something else right away. And then you have the machines. That they can be bricked. Like, if the price goes low enough, and the Bitcoin, they can always produce Bitcoin, of course, but it could be that they actually operate at a loss depending on the electricity cost. So in a bear market, nobody's going to want to buy your machines, at least not for any decent price. Like, they'll give you pennies on the dollar. So it's just something to yeah, it's just something that the mining space is going to have to figure out. Like, in order to survive cycles, because they're going to keep coming, there needs to be some idea of, like, how to hedge or how to diversify in a way that you stay robust, that you can stay keep operating in a bear environment. Even this short crisis, I think, is really making them sweat. We can talk about it more, but I think this is not going to be like a protracted bear market.
Ah, interesting. So, yeah. So, as you were saying, miners might be, or some miners might be in a position where they have to puke not only their coins but also their machines. Like, so if they're in real trouble, they might have to start trying to sell.
Yeah, and
And
I mean, in a way, they can pass on the buck, right? Because if they pledge them as collateral, then the problem is
it's
these
the
guys,
lender
like
now. The lender
the
is the
lender,
one with
right?
the issue.
Yeah, then
Yeah.
the lender is, because then you can say, like, all right, you can pick up my collateral, and then they just come collect a bunch of bricks. Yeah.
Right. And so then the other aspect of it is maybe there was this bull dynamic causing extreme risk and leverage in the system, right? So people offering interest rate and yield because everyone's starved for yield in the normal financial system. They're getting under 1% or paying negative rates in Europe on their normal bank savings account. So they're running into these so-called crypto markets, seeing, oh, look at all the yield that I can get if I just put my money with this provider. And so I think I wonder as well, are there questions to be raised there around the business model? Is it that the business model is sound, but people just went crazy with it? Or do you think that maybe there's some fundamental problem with yield being offered?
Yeah, it's really interesting how people bring their own biases to the Bitcoin space. What was the other example I was thinking of? So you saw it in yield. Oh yeah, so in when I first got involved in Bitcoin, pretty quickly there was this mining craze in like 2013. Like the price was going up, but so many people were just like, "Oh, I'm gonna order mining rigs," and and I think that came because they're not used to a hard asset. They're not used to actual scarcity. Like they're just been conditioned to believe that in order to make money, your money has to work. Like Warren Buffett always says, like your money have to work for you. Or like Kevin O'Leary used to be like, oh, my money is like little soldiers, and I send them out to war, and then they fight and they bring back the loot. So that was like how people got kind of hoodwinked into investing dollars into mining rigs that never arrived or that didn't do it for them versus just buying scarce bitcoins. And so I think similarly, the new generation of Bitcoiners, a lot of them were conditioned that you got to make your money work for you, and you need to like find a yield somehow, kind of not sitting down and being like, hey, but well, like if my money is actually scarce, I don't need interest to compensate for the dilution every year. I don't need that. I can just kind of focus on keeping it safe. Um, so I think it's a little bit easy to say like, oh, people are just greedy. It's just like, I don't know. There's a variety of factors at play. Um, I'm trying to remember your question.
Right. Well, I was talking about the business models of the yield. Like it could be that
Oh,
maybe
right.
if you're a business offering some yield, that maybe the business model is not inherently bad, but maybe people went overboard with the risk and the leverage,
Yeah.
and that maybe if you were much more tamped down about exactly what scenarios you would loan for, as opposed to what we were seeing and what we're seeing blow up now. I'm curious,
Yeah.
do you have any thoughts on that idea? Like, is the business model inherently bad, or is it just that the market just went crazy with risk and leverage?
Yeah, I think the business, there is something to be, there is something to be said, and I think there will be an entire industry built around lending Bitcoin for a fixed amount of time and then getting it back with interest. Like that's a traditional loan. A deposit contract you ought to pay for, which sounds weird, but like if you park your car in a parking garage, you pay. If there's a parking garage that says, hey, we're going to pay you to park your car with us, that's weird, right? It might mean that on the other side of the parking garage, there's a sign, cars for rent. And they're going to like rent out your car while you're just on vacation, and then it comes back damaged and whatnot. So those are two very different industries traditionally, and only the past 100 years with central banks being able to bail out banks have those models been fused into what we now know as banking, where they're both a lending intermediary and they're a depository institute or whatever you call it, a custodian. And those models are antithetical. Like you cannot blend them without blowing up. But unfortunately, people are not educated, so they just think that this is how banking works. But so, in terms of being a lending intermediary, um, or you could do a hedge fund, right, where you accept an investment, and then there is only certain conditions where liquidity becomes available. Like that's how you do it. It's like you are locked in for 1 year, and then if you put in the request, you have to wait 60 or 90 days, and then even then we can pay you just so that to compensate for the fact that you're investing in longer term assets, longer term contracts. So then when you get to the nitty gritty, like how do you actually make a yield? Well, the most straightforward thing is that you're going to lend it out. Like you're receiving the Bitcoin that people want to invest, and then you're going to lend it out to other parties. And so what we're seeing now is how wrong that can go. Like if you lend to Bitcoin miners, for example, that can go really wrong. If you lend to other hedge funds, that can go wrong. That can go to zero. If you lend to a shitcoin, that can go wrong. If you invest it, it can go either way. Like if you buy another token, it can go up or down. What I did with my little hedge fund back in 2019 was we used the Bitcoin that was deposited in our fund as collateral, and then we borrowed some dollars against that, and then we bought some more Bitcoin with that. So we would like slightly lever up, and the idea would be that if we were right that Bitcoin was undervalued and the price would go up, then you have $1 profit. You sell those Bitcoin at some point, and you pay back the loan and whatever's left. That's your pure alpha. That's your alpha on top of Bitcoin. But that was, to me at least, that was so stressful and scary, even with the conservative leverage that we had, and with the metrics in place and all that, and being right with timing. I was right. Like to launch the fund at $10,000 Bitcoin was the right time in 2019. But even so, like I lost so much sleep over it, just worrying like, what if a black swan event happens and the market goes against us in a matter of a week or 2 weeks? And so I ended up, for that reason, and maybe also because my personality, I found out, is not fit to deal with that kind of stress. I wound down the fund. We had, in the end, even though markets were really volatile, because it went, I don't know if you remember, but like 2019, like price went to 5,000 to 15,000, like it was bouncing all over the place. So we ended up with like a 4% loss in Bitcoin, and I felt terrible. I thought this is terrible. I really needed time to kind of like, all right, what basically to not double down. So that's hard, right? Being in that position where you're down, you're kind of like not doing your job, strictly speaking, because you're meant to be better than the market. So then you can choose to either double down and try to make up for it, or you wind it down. And so that's what I did. And it was a hard decision to do that. But so, seeing Murat's fund, I forget the name of it, like they collapsed in early
Adaptive
2020, I
capital.
think.
Yeah.
What was the name again?
I think it was adaptive capital. Yeah.
Adaptive Capital, yeah. So they collapse, and then especially now, seeing Three Arrows and the other funds, seeing them go to zero, I feel a lot better about like having lost 4%, and trying that strategy. But so yeah, just from experience, it's very very hard to make a yield in Bitcoin. I think there is something to be said if you lend to a market maker, like that is pretty safe. Like if you lend to like a Square, right? Like they just need, they're like a vending machine. So they need inventory to sell the Bitcoin, and they immediately buy more but they need a bit of inventory. Or like even a gambling website, like back in the day, like Satoshi Dice, or, the house needs money. And then you kind of just pay it out, but statistically, that you're fine. Or any Bitcoin exchange, like they also similarly need a pot of money to kind of pay out fees and deal with that. And and also lend to people that lever, right? So that's a kind of a safe way to do it, especially if you only do it in Bitcoin, because the most liquid market. If you lend to people that lever up, you can pretty much always liquidate them if you have safe margins and if you have your system set up. So but the problem is that it's so lucrative and reliable that most of these operators have their own Bitcoin to do that with. So anyway, so it's just like, I wish I had better news, but if you're looking to make more than 1 or 2% per year, it's going to be really hard unless you're going to do active trading and have some kind of
And
leverage
taking additional
strategy,
risk, right?
which can blow up. Yeah. So it's
Yeah.
Bitcoin is hard money, and yeah, it encourages saving and not so much yield generation.
Right, and I think that's a good point. And the way I'm interpreting you there, then, is it's saying essentially that it's not that the overall business model is totally flawed. It's just that
No,
the
yeah.
actual return and the sustainable yield that's possible without taking like very very high levels of risk is a lot lower than what people were perhaps being promised, and certainly not the lunar UST anchor protocol with 20% return. Obviously not sustainable. And so I think perhaps what's happened is this competitive desire in the market, and people are having to offer more and more and more to attract in the retail money to put their deposits in, and then unfortunately there was a lot of risk being hidden in there that people were not really thinking that through, unfortunately for them. And so I think it
And I
also,
would add, sorry,
yeah,
I would add the what is flawed is fractional reserve banking as a model, because you cannot promise perpetual availability of your coins and a yield, because by definition, to create the yield, you have to let the Bitcoin leave your own facility and lend them out or whatever. So it's called maturity mismatch. Like there's gonna be a mismatch, and so that means that when there is a bank run, you're gonna look at the movie A Beautiful Life. That's a bank run. People cannot access their money. That's what we're seeing now in Voyager. They're like reducing the amount of money that you can withdraw. To me, that's dishonest. It's like either you have a lockup and you're transparent about the risk, or you're just a pure custodian, you're boring, and you charge money for custody. Like that's what I think is what it should be.
of course, yeah. And so this also very deeply gets to that question of, should the industry tolerate rehypothecation? Should the industry tolerate fractional reserve banking? And obviously, I think you and I are probably aligned on this idea that no, we should just be operating in a full reserve banking world. And of course, there's a big debate about this, right? In the Austrian world, people like Bob Murphy will debate people like George Selgin on this exact question, right? On the question of, does fractional reserve banking cause financial instability? And so this also brings us to that question around arguably what one of the guiding uh, motivations behind Bitcoin. Satoshi put this message about Chancellor is on the brink of bailout, right? Chancellor on the brink of second bailout. And so I think that also brings to mind this whole question about who is the one to do bailouts. And this, I think, perhaps is what causes people historically to cry out for some kind of entity that's going to do the bailouts, right? Namely, the Federal Reserve, or
Yep.
the government intervention. And I think this is probably a good spot as well. You had a thread on Panic of 1907. So, do you want to tell us a little bit about what happened here?
Yeah, yeah. I mean, like if you read the Wikipedia page, it's a little bit confusing, like what actually went on here, because it's so tempting to just be like, oh yeah, and so, which by the way is true. Like there was a bank, the Knickerbocker Bank, one of the largest banks at the time, and they invested kind of in the Three Arrows capital of 1907. They invested in a fund that was like, hey, we are spotting this opportunity and you're going to make this return on your money. And the strategy of that fund was they were going to squeeze the shorters. Like there was a bunch of people short this copper company, and so they were going to be like, let's just go in and buy lots of those shares and we'll squeeze out the shorts and make a really hefty profit. And it went wrong, and so the thing went wrong. That whole scheme imploded, the whole fund imploded, and as a consequence, the Knickerbocker Bank, which apparently was too over levered, they went under. And then there was Contagion, similar to today. So I think that the point that matters is not the exact details of like what was the spark, but it's like, no, there was a forest fire. And why did it happen? Because there hadn't been a forest fire for a long time, but also because growth had been incredible in the U.S., which I think that's where there's a valid analogy with the Bitcoin space. We've had so much growth. People are starting to assume that we're going to keep growing the next month, the next 6 months. And that's where the leverage comes in. That's when people get greedy and they're less diligent with their research, so I think that's what happened. And just to kind of validate my point about how the economy of the U.S. had been growing up to the point of kind of arrogance, you could say. In the 40 years from 1890 to 1930, this is like the golden age of the gold standard. The 40 years from 1890 to 1930, oh, sorry, but I'm just noticing it's 1930. But so to give an idea, like it's that period of very high growth. The population of the country doubled. The value of farm property increased 3.5 times. Pig iron production increased 4.5 times. Exports quintupled. Coal production quintupled. Freight traffic, which is train traffic, 5.5 times. So it's like enormous explosion in activity and productivity. Um, so um, so yeah, so the bank blew up, and there was contagion in the system, and so people like the Rockefellers and J.P. Morgan, they stepped in. Like they had a lot of cash. They were basically prudent financiers. Like they were not all in. Like they had reserves, kind of like Warren Buffett today, like a bunch of reserves, and you could. That was more justifiable at the time because you had hard money. So you could have your reserves in gold, and that would gradually go up. Like there was a slight deflation every year. And so yeah, so they started rescuing these companies, but of course nothing is for free, so they would kind of do it in exchange for equities. Like you're in distress, all right, I can buy a bunch of your stock at a haircut. I'm going to buy it at 30 cents on the dollar or whatever, and then you're going to live another day and your customers live another day. And so that's how the contagion was stopped. But the public at large was like resentful against these you know these what they saw as profiteers, like people that profited off the crisis. And so they apparently thought it was a better idea for the government to be like the final backstop. And that's how the Federal Reserve was founded. If you look at the original Federal Reserve Act of 1913, the literal first paragraph is talking about the panic of 1907 and what happened, and that we need to prevent this from happening again. So what the government is going to do is have this vast, they present it as like a dam, like we're going to dam up the river and create a vast reserve of funds so that when there's another crisis, we can be the JP Morgan, and we're going to do it out of the kindness of our heart, and we're going to save these institutions. But of course what people didn't realize is that that opened the door for the dollar itself to be gradually undermined and poisoned and become just a paper certificate. So in the end, the cure was way worse than because the 1907 crisis only lasted 18 months. Like the stock market almost entirely recovered in 18 months. So there was not like mass unemployment. It wasn't like a Great Depression at all. And that is the nature of crises in a healthy economy. It's like a healthy person, you get sick and you heal in a matter of months instead of becoming ill for 10 years because there's something constitutionally wrong with you. So I think that's an important lesson, is that, if you look at the duration of crises in the fiat era, they're way longer than in the hard money era. And so this is just an important, I think, time to reflect on these things and not to think we're doing something fundamentally wrong. We need new rules. We need new institutions. We need a Federal Reserve of Bitcoin. Like, no, this is just normal. This is just normal. And Bitcoin has had many of these little crises, and we'll have many little crises in the future. We don't need to really change anything. If anything, we just need to educate ourselves better and other people better. And that's it. Build better technology, maybe.
Right. And so we can certainly see there's an inkling of what's going on, that maybe there's some similarities. People have been commenting publicly saying Sam Beck, SBF of FTX, they're sort of making this analogy that he's like the crypto JP Morgan, that he and FTX have offered a loan uh, for BlockFi, and
$250 million. Yeah.
yeah. And so, in a similar sense, there's this argument going there, and then is there going to be a parallel in the future that, let's say, the government may use this crisis, or other actors may use that crisis to say, "Oh, look, see these crypto kids, they can't, manage their own thing. So, look, me, the responsible, mature adults in the room, have to come in and etc." Right? We can all sort of see how that argument is going to be played out. Of course, even if we disagree with that, and so I think it is important to point out how Bitcoin is different, right? And as you did do in your thread as well. In what ways is the Bitcoin world different to that?
Yeah, I mean, what we have that they didn't have back in 1907 is very high auditability features. You know, you can selectively make things transparent in the Bitcoin space. And so, for example, collateral can be monitored, and you know it's always there. You don't have to just rely on the word of somebody else, and it's not like magic that, you know, but it's a factor. It's something that can help. It's not a silver bullet, I think. Um, and because it's true, you know, that you don't, if there's overlapping claims on the same Bitcoin like that, it's a bit tricky. Like, presumably, if people pool their insights, maybe then it's for cryptographers to figure out whether we can do that. But there's definitely, for sure, there's much more possible than with gold. Like, auditing gold is a nightmare. I think the last official kind of a somewhat of an audit of the Federal Reserve was like 1953. Sorry, Fort Knox. Like, if the gold. So auditing gold is really really hard. Much easier to do with Bitcoin. You can do it from a distance. You don't need to physically be there. It's so much better. Um, so technology wise, that is a factor. Multi-sig, of course, allows us to not only reliably store Bitcoin, but not have to trust on one counterparty. Like, I think in the future, we're going to not have custodians so much as we're going to have key banks, like banks that are known to store keys, and then they will collaborate to store particular pools of Bitcoin in a multi-sig fashion. So then you can have a bank in Australia and a bank in the US and a bank in South Africa, all collaborating, securing the same multi-sig wallet. So it just ensures against a lot of political risk. And so the fact that Bitcoin is maybe that's another factor. Bitcoin is digital. So back in 1913, pretty much you have the United States as a country. It would be so cost prohibitive for physical gold, to leave the continent. So the risk of the gold fleeing abroad was very low. And so they could be sure, like, you know, we can do this. Like, what are they going to do? Right. I mean, the money already is in the banks physically. So we can just require the banks to hold a certain certain percentage of their gold with the Federal Reserve, so that we can come and, you know, rescue the banks that are not doing well. Which, by the way, isn't that crazy? Like, sorry, but just to make the point, like, you're going to reward the worst actors, like banks that are um, um, lending intermediaries that are responsible. Like, for example, and not that I'm promoting them, but like, I think, for example, maybe like a Genesis Capital seems to be coming out of this crisis relatively unscathed. Um, there's a few examples of companies in Bitcoin that have barely been hurt by the whole, you know, this whole panic. Shouldn't they be rewarded by the market, right? But so instead, what you do with the central bank is that you start subsidizing the worst actors who take the biggest risks, and then you get a really rotten system. So anyway, so I think that the fact that Bitcoin is digital, and there's always the risk of the capital just fleeing abroad, even if it's technically still owned by U.S. citizens, I think that is going to also prevent some of these wild ideas of, like, let's just pool together all the Bitcoin.
Right. And so it's certain technological aspects and arguably even maybe a cultural aspect of Bitcoin, this whole not your keys, not your coins culture, I think, because what are the things that help governments drive us down into this pathway that we're in with fiat currency? One of them, as argued even by many Austrians, but Guido Hulsmann makes the argument really well in The Ethics of Money Production, is this idea that with government legal tender laws, they force us to consider the IOUs all as equivalent. So, as an
Yes.
example, if you have an account at Wells Fargo and I have an account at Chase or whatever, we treat all our IOUs the same because of legal tender laws. And so there's maybe a bit of an argument there, right? So I guess now let's transpose that into Bitcoin land. It would be like saying you have an IOU at, let's say you have some coins at, you know, uh, Cash App, and I have some coins at Swan. And treating them all the same. But in a self-custody culture, you don't have to trust that the IOUs are the same, and we don't treat them differently, right? We don't say, "Oh, I'm assessing, you know, whichever lender, like Celsius as a bad actor, so I'm gonna in my mind I'm gonna value their bitcoins below par, right? I'm not gonna treat the bitcoins
Yeah.
held there, right? But let's say it's a reputable actor, okay, I'm gonna hold them at par in my mind mentally, like okay, coins held here are 1-to-1. So I think that also plays into it as well. This idea that we should really be more cognizant about where it's an IOU versus it's actually coins that you hold in your wallet, not your keys, not your coins.
Yeah, and we saw this in the last days of Mt. Gox, when the market was starting to feel like, oh, this thing is going really wrong before the official bankruptcy, the official failure. You saw that Bitcoins there were trading at a discount. So they were cheaper because they were Gox coins. They were locked into Mt. Gox, and you just didn't know if you would ever see them again. And then interestingly, this is just a side note, but interestingly, actually, Bitcoin traded at a premium on Mt. Gox before that. And the reason was that people that had coins stuck there, they wanted them out, but they were um, uh, Gox was throttling the amount of Bitcoins that were allowed to go out. And so what you would do is you would sell them on the platform and get your dollars out. And so, because a lot of people it's like literally the showing that people were trying to exit. They were all like kind of like, pushing towards the exit. And so they were bidding against each other to get dollars for their Bitcoin on the Gox platform and then get the dollars out. And of course that failed too. But it's just interesting to see how if you allow a market to operate, there's so much information communicated by the price.
Yeah, so I think maybe that's really the lesson is to basically people need to assess which parties and companies they work with. And if a company
Absolutely.
goes under because they did some bad risk management or they took the wrong risk, then they should be allowed to fail, right? I think that's
I've always
probably
advocated for diversification, and I don't mean shit coins. I just mean like diversify the ways in which you store your Bitcoin, because we are fallible individually, but also institutions are fallible, and so just consider that. Like I think that's probably one of the wisest things you can do if you own Bitcoin.
right. And so for listeners who are thinking, okay, are we staring down the barrel of a long bear market, or do you think it's going to be a shorter one? That okay, it might take some time. What's your? Do you have any thoughts on that?
Yeah, I don't think this is going to be a protracted bear market. Like, I mean, definitely, it's probably obvious, but there's definitely been. Let me pull up this chart for myself. Um, Definitely, there has been. I'll just wing it. Um, like the hubris is flushed out, right? I mean, people are not like overconfident anymore, which is always good. Um, Also, the actual leverage is being fleshed out. Like somebody messaged me that they were managing funds back in 2008, and he said in 3 days all the leverage was flushed out, and it's because it's so contagious. It just like cascades, and so it's only that only lasts so long. I do think miners need to capitulate. That'll go slower because they don't get their margin call right away. They get like this slow trickle of like they have to pay every month, so that can take longer. But then Bitcoin is so small still; it's less than $1 trillion, and we're just seeing the assassination of every single asset class globally. Now, of course, stocks are down. So people are like, okay, if I sell my stocks, like, what the hell do I buy, right? Or if I want to diversify, what the hell do I do? Um, and I think the thesis of the Wall Street types of the world is okay. The Fed is tightening, so we're risk off. This is all risk off, risk off. So just dollar based assets, very short term, maybe very short term bonds or something like that. Um, so, but I think the market is underestimating how quickly the Fed can change and pivot. And I think we're already seeing signals from the Fed. I think I want to like claim the hashtag Powell pivot because I think it's going to happen, and we'll all talk about like how Powell has pivoted. That he goes from playing the hard line, pretending to be Volcker, but he can't, to like more soft talk because the White House is exerting pressure on the Fed because people are hurting because of inflation and everything else. That the politicians clearly are saying like, hey, it's bad enough that we have inflation. You guys are going to create a recession on top of it. Like, no, we have elections coming up, like 2023, 2024 is elections. Um, so I think they're going to turn dovish. Maybe I'm not no Fed expert, so definitely, I'm definitely. This is just pure, amateur speculation. But I think maybe a few more mild hikes, and then they're gonna call it a day. There's some stuff blowing up in Europe today, like the banks are in terrible shape in Europe. The eurozone keeps printing money, like they're not easing. They're not tightening. Japan is going crazy printing money now. Japanese yen has dropped below 20-year support on the chart. So I think the Widowmaker trade is finally paying off. Like there's finally people that are shorting Japanese bonds. They always lost money the past 30, 40 years, but now is the time. Um, and it's I think Japan is going down. So basically, the dollar is the last man standing, um, and I just don't see this tightening continue for very much longer. Like maybe a bit, but we're also even seeing U.S. government bonds yields spiking, so they're going to have to ease more pretty soon. um anyway, so that's my take, is that Bitcoin, we're like, in a way it's great that we're first, like we're the first to have a serious correction. All the leverage is flushed out. I think that's kind of how I opened this interview, is like, this is just so healthy. It's like we're going to be so laser focused, and we're going to have a massive rally, and I don't know when it's going to start, but I suspect that this whole crisis will be over probably in 12 to 18 months, maybe two years tops. But it just doesn't make sense to me that we were barely, like, 2019 was still bear market, right? So like we only had a bull market for 2 years, like in an environment where central banks are printing money up the wazoo, where inflation is starting to get to close to 10%. Like, no, like I don't think we're going to have a protracted bear market at all. This is just a panic. This is not a depression or a prolonged bear market.
Right, and certainly it does seem that most people are confident that Bitcoin is just taking a breather, and they still are bullish on Bitcoin long term as store of value. I think that's certainly I think it's fair to say that most people who are who are holding Bitcoin or in this broader system, that they're seeing it something like that. And so, yeah, I think that's probably the likely outcome. So we'll just have to wait and see. But I think you're right. I think it's going to be maybe a little bit more of a waiting for the minor capitulation, and then sort of chilling sideways for a little bit before the stackers. And this is a great opportunity for those who are stacking. So,
I
yeah,
mean, to be fair to like just kind of the gods of odds and statistics, like if this contagion continues, and if we see like a Coinbase, if we see a bank run on a Coinbase, and it turns out that they don't have what it takes, they don't have enough coin, and then we could go a bunch lower. Then we could really challenge 10,000, $5,000 Bitcoin or something. Like, I'm not saying for a long time, but I think briefly we could see, kind of like in 2013 when Gox went under, like we had a rally to 260, and then we still went down to $80 because Mt. Gox went bankrupt. So if this rabbit hole is deeper than we thought, then all bets are off in terms of how low we could spike. But even then, there's so much Bitcoin that's cold stored. I think if we're talking about the exchange ecosystem and stuff, the financialized Bitcoins, maybe we're only talking about 1 or 2 million Bitcoin. Like there's just no more than that. That is in kind of like semi hot wallets. The rest is just cold stored or lost. So, there's a limit to, and so if you think about it that way, it's like, okay, let's say there's only 1 million Bitcoin circulating in the financial system. Well, then if Bitcoin spikes down, let's say it drops to $5,000. Well, then you could scoop up all those Bitcoin with $5 billion, right? You could just kind of set a bid order, like, work with some large prime broker who has access to all the trading desks in Bitcoin, and just put a firm bid at $5,000 Bitcoin, and you gobble up every single Bitcoin that becomes available at that price. So that $5 billion is not a lot of money. So so that's why I'm like, I don't think we're gonna go below 10,000, even in a bad case. We could dip below it briefly, but I don't believe in a sustained bear market under 10,000.
Yeah, for sure. Okay, yeah, so that's interesting. And I guess one last question and area that I'm curious. So in recent years, we've seen a lot made of on-chain metrics, and I know this is something that you obviously you were involved with using some of this stuff, or Nupal as well. Net, I think it's net unrealized profit and loss, and so it's kind of looking at when this coin last moved and things like this. I'm curious whether you're still as into that. Like, okay, here's one example, right? So is it possible that some of these metrics are getting it wrong? Because, as an example, if you just, let's say you stack some sats and then you upgraded your cold storage, right? That metric might show, oh, look, this coin was sold, but actually you're just keeping it, you're just moving it from your left pocket into your right pocket. I'm curious your view on that. Like, would you say that diminishes the information that can be gleaned from these metrics, or do you see it like, oh, that's rounding error stuff? Like, this metric is still overall valid.
Well, I remember talking about this with Tomas, who came up with the metric. Is like, yeah, so like how valuable, how valid is it if somebody just moves their cold stored coins? But his point was that basically it is an important event because you are reasserting your control over those Bitcoin, and so it's a conscious decision to either keep them or sell them. But you are like, they're right there. You could sell them in an instant if you wanted to, because you went through the effort to get them out of cold storage and all that. And so I do think there's an information component that's important. And so even if we look at net unrealized profit and loss, I'm looking at it on Glassnode right now. Like, you do see that the ratio went above 0.5, which is an indicator historically of like, not necessarily euphoria, but definitely like kind of a lot of optimism. So the metric went to there in I think it was pretty much when Bitcoin was close to the top, when we hit the like 60,000. Like, that's when that metric really spiked, and now it's dwindled down, and now we're at like 0.25. So basically, what it means is, if you take all the Bitcoin together, um, based on when they moved last, is the market as a whole in the green? Like, let's say there was only one owner of these Bitcoin, and assuming that every time they're moved on the blockchain, it's a sale or a purchase event. Um, Judging by that, is the market as a whole in the green, or are they at a loss? And so right now we're still in the green somewhat. It only really went to a loss in. I'm sorry. I think this. I feel a little bit embarrassed because I'm looking at a chart that's actually not updated sufficiently. So
Ah, right. Okay.
I'm gonna have to look at a more updated chart. So that's why basically, maybe we should even try to cut this, because I don't know if there's a lot of information of me talking about what happened.
Gotcha. Sure.
Um,
Sure.
I
Yeah.
pulled it up
So
just before the call, but I need to like look into it more. But so
yeah.
basically,
Sure.
I have not been looking that much at on chain metrics, even in the bull market. Um, it is in the short term. It's quite interesting to see if there's a move in the price, to see if old coins, if the whales are basically doing something. Like, I think it's in that sense it's interesting, and usually the whales are pretty unfazed.
Gotcha. Yeah. Interesting to see. And so then I guess let's let's leave it there then. So I think really interesting commentary, and I think it gives us all some things to think about in terms of how the industry and ecosystem develops. How much should we care about technologies? As an example, proof of reserves, the culture of not your keys, not your coins. I think these are all, and arguably, it's easier to sell that message after a moment like this, right?
Yes.
Like just like after Mt. Gox's collapse, it's a lot easier for people to get the message about self custody of Bitcoin. So I suppose we'll leave it there then. And listeners, go and find Tuur online. You can find him on Twitter at Tuur Demeester, and anywhere else you want people to find you.
No, that works.
Okay, fantastic. Well, thank you again for joining me, Tuur.
Thanks, Stephan. My pleasure.